In order to evaluate which markets would be the most profitable for a big pharma company to enter, a metric called indicative profit potential, or IPP, was used. And this was measured along 10 different healthcare markets. And based on those calculations, what was found was that branded prescription pharmaceuticals still offer the most money-making potential, and is a clear indicator that big pharma companies, regardless of their level of focus or diversity, should maintain participation in this market. Now, if companies are looking to implement a diversification strategy outside of branded pharmaceuticals, the next most profitable market to enter based on this IPP metric would be medical devices and diagnostics, where there is a strong market size and average operating margins. And diagnostics particularly offers an attractive option because of the synergies that exist between big pharma companies' existing pharmaceuticals businesses and diagnostics, as more of these companies look to implement precision medicine development strategies. A big takeaway for me from the case studies that were done in the report was just how diverse this group of companies is, ranging from those that are extremely focused on branded pharmaceuticals to those that have a smaller stake in that and also play in other healthcare markets. And I think a good example of this is Johnson & Johnson. At one time, its CFO, Dominic Caruso, described Johnson & Johnson not as a pharma company or a device company or a consumer health company, but rather as a healthcare company. And I really think that gives a lot of insight into the way Johnson & Johnson not only perceives itself, but wants the industry to perceive it. Johnson & Johnson has managed to run a pharmaceuticals business that has done quite well alongside several other significant businesses, including medical devices as well as consumer health, which bring in significant revenues for the company. And particularly in consumer health, it has been able to turn around those sales following major recalls to its Tylenol brand several years ago. And looking forward, Johnson & Johnson may look at doing a major acquisition in consumer health and also drum up investments in digital health to drive up direct-to-consumer sales. Mergers and acquisitions largely shape big pharma strategy and as a result shape big pharma revenue. And from this activity, we can gain real insight into not only the new markets that big pharma companies want to enter, but also where these companies want to continually invest. Historically, products that have been brought in through mergers and acquisitions have been the strongest growth drivers for revenue. So these are really important assets. There's been quite a high volume and value of mergers and acquisitions done over the past 5 years, with approximately 122 deals signed by big pharma companies that together were worth $301 billion. And unsurprisingly, the majority of the activity that has been done has been focused on branded pharmaceuticals, with about 2/3 of the deals signed being done in this area and the rest in diversified markets. For companies that were looking to diversification strategies in terms of their M&A activity, the most popular acquisition targets were in the medical devices and diagnostics area, and Roche was particularly active in diagnostics, and this is not surprising given its expertise in the molecular diagnostics arena. Divestitures are an important tool that big pharma companies can use to shed non-core assets and really narrow down their focus. These companies are constantly reevaluating their portfolios and conducting strategic reviews. And as a result, many of the divestitures that have taken place over the past 5 years have been around branded pharmaceutical assets as these companies look to focus on innovative drug development. Big pharma companies have been selling off diversified operations, namely in consumer health and animal health, as they look to put more efforts into innovative drug development areas. And there are many examples of this, including the major consumer health sale that Merck & Co. did with Bayer, as well as Eli Lilly buying Novartis's animal health unit. Another interesting example in the consumer health area is GlaxoSmithKline. Over the past several years, GlaxoSmithKline has divested several non-core consumer health assets in deals with companies such as Prestige Brands and Omega Pharma. But consumer health may be considered a very significant business for GSK, and this has been evident just recently with GSK exercising its option to acquire the remaining stake in a consumer health joint venture that it set up with Novartis in 2014.